private markets versus public markets, and why you believe the big opportunity right now is in the former and not the latter.
Look, we've had a sea change, not just over a year, we've had it over 15 years. So much of our public markets are indexed and correlated. 80% of volume S&P 500, 60% of the market ETFs. 100% of our returns this year are from 10 stocks, which constitute 35% of the S&P, that trade at an average PE of 50. How many of us come in every day looking to buy 50 PE stocks? Not many. And I guess what I'm suggesting to you is that public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
Is that not inherently a risk in your mind, liquidity?
Well, liquidity is a risk to everyone, but in different degrees. So if you are a retirement plan or a retirement system, you know your liquidity requirements for the next 10 years. So if you can get paid for illiquidity, why not get paid for illiquidity? If you're a wealthy individual, how many of them need 100% of their money on Tuesday? If they don't, they should get paid for illiquidity. And we're seeing that in the performance data. If you look at the active management has failed to beat the index 85% of the time for 20 years. And I think it's going to get harder, not easier, to beat the index. As more and more of the market is indexed, very little money is left to actually make up what needs to be done in active management.